Ladies and gentlemen, good day to you all. It's 6 p.m. in London, it's 1 o'clock in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco. Good morning, West Coast. It's 10:30 at night in Mumbai. Greetings. Good morning, good afternoon, good evening, depending on where you are in the world. My name is Patrick L. Young. The IPO video livestream 011 starts here. There's a fascinating competition between public and private sectors in the United States of America, with Elon Musk eager to get way beyond any orbit he has managed to smoke on Earth. And NASA are also targeting a moon landing, a Mars landing and a moon landing. Indeed, NASA have recently announced some newfangled turbo-nutter nuclear propulsion device, which they think might get folks to Mars in half the time compared to current rocketry, a mere 90 days. With NASA now reckoning they can make it to the red planet by sometime during the 2030s, it's not beyond the bounds of possibility we'll see men on Mars before the Australian Stock Exchange manages to install its CSD replacement technology for chess. Equally, given that recent research shows there could be 300 million planets out there that support Earth-like life, one wonders, does Joe Biden have a transition committee for inviting outgoing President Trump to be president of one of these new planets? Imagine, ruler of your whole own planet, President Trump. If you didn't get that joke, let me note, in case you missed it, there was an election for the US presidency last week. I know they kept it incredibly quiet across the media. A little note for our dear friends in the American legacy media. There were not spontaneous fireworks on November the 5th in the UK to celebrate the announcement that Joe Biden may apparently have won. No, rather, that's actually celebrating something several hundred years ago in history, pretty much not that long after somebody discovered the United States of America, in fact, where there was a famous Guy Fawkes parliamentary plot to try and blow up the Houses of Commons. Anyway, enough of that. We're preferring markets over political discussion in this live stream, and indeed back on planet Earth in the corporate world. It's interesting to see that Louis Vuitton, Moët Hennessy, LVMH and Tiffany have finally sealed a merger at a lower price to what we were discussing several months ago, when of course that deal went pear-shaped as a result of the early outbreak of onset of COVID. After that moderately epic post-COVID reprice, it makes me wonder why we don't have a similar renegotiation going for, say, LSEG Refinitiv. It's not as if one couldn't argue the world is not substantively different to how it looked way back when BlackRock started flirting with the London Stock Exchange's Group C-suite to offload the BlackRock Refinitiv purchase. However, many great things happening in the world of corporate markets these days, and of course, all eyes are on Pfizer and their miraculous wonder cure, of which we're not going to talk about any of it today, because our focus is, as ever, the world's financial market structure. And to that end, we have, ladies and gentlemen, coming to you live today across a New York lunchtime, a rock star of the industry. Yes, even greater than Alistair Haynes in many respects, a man who features in the incredible book by Michael Lewis, all about the Flash Boys. He has his very own chapter, Ronan Problem, something which I do believe has been addressed. And of course, that dated back to the time he was originally one of the leading figures in execution technology and execution in markets and equities around at RBC. Nowadays, he's a co-founder, of course, of IEX, the Flashboy company itself. Ronan Ryan, the head of strategy for IEX. Welcome today. You are on IPO Live. It's lovely to see you.
Thank you. Great. Usually I'm the one bringing the energy, and it's hard to step up to the energy after you, Patrick. That was some introduction, and I can only aspire to be as good as Alistair.
Thank you very much, Ronan. It's great to see you. Now, also, call it my masculine intuition, but I've spotted something here, and I do believe that we're breaking new ground in the history of this live stream, which has been ongoing during lockdown. You're in one of those, it's one of those weird places. Let me try and remember it. It's office. Are you in an office, Ronan?
Yeah, absolutely. So there's a small subset of us who are back in the office now. I think we have 150 desks here. There's maybe 8 of us here, and we came back about 5 weeks ago. So yeah, we're in New York. I'm happy to get out of the house, frankly, and it's obviously voluntary for anyone who wants to come back. And it's a little bit funny because New York, obviously, as many of your listeners have been here as well, is normally a fairly vibrant place. If maybe there's 10% of the people there are normally, and there's a lot of chatter about a potential resurgence. So I'm hoping we can stay here the entire time, or we'll see how things shut down. But it's been really great to get back to the office. We've hired 35 people since we all left the office last March. So many of the people coming in now have never actually even met people that they work with face to face other than Zoom or video conference. But so far, it's going really, really well.
That's great. It's great to hear all together. And of course, one of the things which has been an epic success, it has to be said, touch wood, across the whole of the lockdown period has been the uptime that everybody managed, even when they were working from their kitchen tables. So full marks to IEX amongst the many who've done so well in that regard. So you're sitting in the middle of New York. There are not that many people filling the offices around you. How's it feeling to actually go on a commute into Manhattan at the moment?
Yeah, look, it's funny because I literally, before this video, I was just talking to an employee who came in for the first time today, and he was a little unnerved by it, and he had actually cycled over the Brooklyn Bridge. My first time was about 5 weeks ago. Coming in, getting on the subway, I get on a train called the Path, which is basically a subway from New Jersey into New York. And so I drive almost the entire way and take the subway 5 minutes. It was a little spooky because my first morning getting on the train, there was only one other person on the train car. And he looked like a normal guy, so I got on. I didn't want to go into a tunnel with anyone looking like Dracula or anything like that. But yeah, it is definitely ramped up though in the past few weeks, whereby I'd say it's like 10 to 20% on the train. But everyone's wearing masks. Everyone, there's sanitizer everywhere that you go. So those who are back are taking it very serious. Like my wife was worried about us going back into the city, but when I tell her literally everybody is wearing masks and everybody's being respectful of social distance, it's like, frankly, I have to tell you, it's really, really great to be back. And I kind of feel weird saying that. It's like a kid being excited to be back at school, but just being back in the office, even putting on a shirt. I was joking how I put on a suit a few weeks ago for the first time in 8 months. It's been very liberating, actually. And I will say, interacting with the business team here and some of the sales team that are back, we've already, it's already been beneficial for us than staying home.
That's excellent to hear. It's really good to know that you're in the office. And speaking of social distancing, ladies and gentlemen, don't be shy. Ask us a question, post a comment. Feel free to like this, whether you're watching us on Facebook or LinkedIn or YouTube, live streaming as we are today on the 10th of November. Questions are welcome as always. I look forward to hearing what you might have to say that we can pose to Ronan. So, Ronan, tell us a little bit about the IEX exchange and this incredible roller coaster that took you from RBC to being an acclaimed, noted person in a book by one of the most famous business authors alive.
Yeah, no, I'll start with telling you about the chapter named after me, because I think your listeners will find it funny, being that I actually grew up in Dublin, Ireland, so I probably sound American at this point. But in any case, the day the book was to come out, it leaked the day before that there was a chapter. Like, I saw the contents, and I saw Ronan's problem. And I'm married to an American lady, and my father-in-law, who's American, I texted it to my father and my father-in-law, and my father-in-law wrote back. He's like, "Oh my God, I'm so proud of you. I can't wait to see what was written about you. This is great." And my dad, the Irish guy, writes back, "What the fuck's your problem?" Right? So that was my intro to the book that people seem to get a kick out of. But as an Irish father will always put you in your place. But look, in any case, we set out on this mission back in 2011, really left our jobs in 2012. And the idea was, we felt like there was issues within the ecosystem here, and the center of the ecosystem are the exchanges. And sometimes we get painted with a brush of anti-high frequency trading. That's not the case whatsoever. It was more, there are certain strategies whose sole determinant of success is based on speed. And I guess the question is, are they necessary? And all this complexity, who's it good for and who's it not good for? So we set out to be the first trading venue owned by the institutional buy side. So we were formed by about 22 hedge funds and long onlys. And that's how we launched our ATS, which is what they call a dark pool over here. So we launched as a dark pool in October 2013. And I guess what we're most famous for is what's known now as the speed bump. But essentially, We slow trades down by 350 microseconds as they enter IEX. And the real cheat sheet as to why we do that is it just allows us to normalize market data and be faster than anybody trading on our platform. And that sounds like a strange thing to say. To make it more simple, it's basically like we are the fastest participant on our platform, and we're doing that speed. We do that to protect clients trading on our platform. So in the US, it's very different than Europe in that here we have something called the national best bid and offer, and the quotes are protected. And what that means, again, in English is we have to take in all the market data from all these exchanges, and we have to build the best view of the market and say the best bid is $10. That's on NASDAQ. The lowest offer is $10.02, and that's on New York Stock Exchange, for example. And we have to print trades between $10 and $10.02. And that's a regulation in the US. It's called the order protection rule. The problem with that is how quickly we normalize that data to see that it's 10 by 10:02. If people can do that faster than us, they can see price changes on other venues, race over to IEX and know that not only do they know the price has changed, they know IEX does not yet know the price has changed. And this happens on every venue but IEX, because all we did is we gave ourselves a 350 microseconds head start. So sometimes I like to call it that instead of a speed bump. But we see the price change, someone else sees the price change. Even if they're faster than us, as long as they're not 350 microseconds faster than us, we can always ensure that the price at which we consummate a trade, if you will, is the fairest price. It's the true price. It's the actual price in the market, because we've been able to give ourselves that head start in order to digest the market data. And that's the real kind of crux of what we do. And then on top of that, we built a machine learning model where we noticed some people were actually predicting the price was changing before it actually changed. So the speed bump protects you from someone seeing the price actually change and being faster than you. We addressed that. But then we saw people are predicting which way the price is going, and they're trying to trade with you right before the price changes. And like in the US, I'm not sure if around the world, everyone calls it adverse selection. But if you look at how much volume happens in the US market where you bought stock at $10 and less than a millisecond or two later, you could have bought it at $9.99. It's massive. It's over 50% of all the volume. So what we did is we wrote a model to predict the exact same quote crumble. And if clients elect to use the order type, we'll actually move you out of the way of trading. If we think the price is 10 now and we think the price is going to be $9.99, we'll give you the option to move you to $9.99. So that's the speed bump, and that's our machine learning model. That's as complicated as I can get probably on this web stream, but I'm happy to answer any questions on it.
It's absolutely fascinating altogether. And obviously, I mean, when you build the system up, just give us a run through of the specialities that you and Brad and the other co-founders brought to the picture.
Yeah, no, that's a great question, a fair question. So there's four of us who started IEX. Brad was 3 of ours manager at RBC. So Brad ran electronic trading at RBC. Prior to that, Brad had been a cash trader for years. So like he was on the high touch desk, like interacting with clients. He took over electronic trading and obviously did a fantastic job. Rob Park, our CTO. Rob Park was a technologist. He actually had done his own startup quant firm before this. John Schwal was a global head of product for electronic trading. And then I had a weird role in that I actually grew up in the networking space. I worked in the telecom space for a number of years. I was trained to do network engineering. I used to do circuit installs, all kinds of stuff. And in early 2005, I got involved in low latency circuitry, meaning people at that point, the biggest, the longest pole in the tent, if you want to use that expression, the biggest introduction of latency was just distance. So if you want to take in data faster, if you have a faster circuit from point A to point B, then you're going to get the data quicker. So I started working on low latency technology very, very early in the game. So I worked in the data centers, and I worked with a lot of the high frequency community and the brokers just to give them faster connectivity between all these buildings. Like co-location obviously is a word that's used quite often now, but back in 2004, 2005, no one knew what the hell co-location was. And co-location is just if you get the signal quicker by having a faster circuit. You know how you get the signal even quicker? Put your computer and your strategy in the same building as the exchange. So then I started to work on that. Anyway, I wanted to work on Wall Street, work on a trading floor. It's something that had always excited me. And life is a funny thing. It really is. Like people say, you make your own luck, and that's true. You got to work hard, but you got to have a bit of luck. And I had a bit of luck. I just got introduced to Brad as he had taken over electronic trading. And at that time, like I said before, he was a high touch trader. He didn't really know much about electronic trading whatsoever. I didn't really know much about trading. And it sounds like a story in a book, but it is a true story. On my first day of working at RBC, I came into his office and he asked, "How's the first day going?" And I had just sat through a 3-hour algo meeting, and I told him I literally have no idea what the fuck these guys just said. And he couldn't believe how direct I was. He's like, "Wow." And he goes, "You think what we know, you think what we know is rocket science, and we kind of think what you know is rocket science." And right then and there, first afternoon, we got on the whiteboard and we started drawing out where the data centers are in New Jersey, why that matters. Because in the US, you've seen 3 new exchanges recently. But if you look at the exchanges, you have names like New York, Boston, Philly, Chicago. All of those exchanges, all 16 with all these different names, they're all in New Jersey, and they're all in 4 buildings in New Jersey. Why? And what does that mean? And how do you interconnect with them? And that was really, really my world. So the 4 of us sort of plowed ahead at RBC, and we developed a product called Thor. And it was just a smart order router. And I guess what I would say, and it's the same thing we do at IEX, is a lot of times people will complain about market structure, complain about high frequency trading, good, bad. I'm indifferent to that. But basically what we do is we'll look at technological issues or inefficiencies and try to address them with technology. And a speed bump, that's just physics delay. So in essence, that's what we did. We took that show on the road and created IEX, and we're doing the exact same thing there.
Fascinating altogether, ladies and gentlemen. I'm here with Ronan Ryan. He is the president and a co-founder of IEX, the company which, of course, was immortalized originally in the Flash Boys book, and they've gone on to, well, much greater success ever since as one of the leading ATSs in the American marketplace. We're talking about the 16 different exchanges in the US at the moment. I'm actually surprised it's only 16. It feels like 2.5 million. We'll get to that in just a second. It's really, really interesting. I mean, looking at that exchange environment, you're saying, of course, the fact that all four data centers in New Jersey are essentially where the exchanges are housed, including things that have got exotic names, not just like Philadelphia, but even Miami. That's the one that always
correct. Oh yeah, I should have said that one.
even coming from Belfast,
New Jersey's not Miami.
No, Belfast, Dublin, Miami is nowhere near New York. I'm quite sure it's pretty closer to Dublin some of the time. Yeah. It's quite incredible how that whole landscape has moved, and you've seen so much change. So, what's been going on recently that has particularly excited you in and around the exchange landscape?
I mean, what I'd say, and what a lot of people are talking about, obviously I took my own book, so I'll talk the new entrants to the market. So in September, there was a launch of basically 3 venues. There was the long-term stock exchange, there was the Miami Stock Exchange, Pearl, which is what they're calling it, and then there was the MEMX Stock Exchange. So MEMX Stock Exchange is a consortium of broker-dealers, mainly led by Citadel and Virtu, and they launched an exchange. And no disrespect whatsoever in how I state this, but it's sort of like a Me Too offering. It's about speed, technology, co-location, rebates. Very, very similar to how all the other exchanges operate. IEX has gone the complete opposite way, but we can talk about that separately. The other exchange was the Miami Stock Exchange. The Miami Stock Exchange, I'm not sure if listeners know, they currently run 3 options exchanges. So this is their first foray into equities. And they launched, and both MEMX and MIEX did sort of a slow launch where they rolled out over symbol ranges. But I believe now, as of a couple of weeks ago, I know MEMX is actually up and trading all symbols, and I think Miami is getting there. And then, and again, Miami have fantastic technology. If you look at them from an options standpoint, their technology is often referred to as the best options exchange. So I think they're taking that show on the road to equities. But again, no disrespect, love the people over there. They're doing a very similar Me Too offering. It's co-location, it's high speed, it's maker taker. It's the basically cookie cutter of what most every exchange does. The one that's kind of interesting and very different, and admittedly they'll tell you, they only launched the stock exchange because they had to. So the long-term stock exchange was born out of a book written by this guy Eric Ries called The Lean Startup. And within there, he was talking about how you could bring your company public and still bring your company public as like an entrepreneur and still have a lot of control over that company. So basically, what he did is he set out to create the long-term stock exchange, but the business model there is to win listings, and they have very different listing standards. More listing standards to like the entrepreneurs and the startup folks than the current listing standards. And they did not, in fact, want to really launch a stock exchange. But in order to be a listings venue, and I guess it's the same thing globally, you actually have to open and close the stock. So as such, they've created an exchange. They've launched an exchange. And again, no disrespect to them, but they're trading a few hundred, like 100, not a few 100,000, a few hundred shares a day. So they haven't announced yet any company switching their listings over to them or any company IPOing on them. But I would imagine because they launched when they did, they must have plans to do something like that. So I would say really the difference in market structure is more MEMX and MIEX, and LTSE is an exchange by name, but it's not really an exchange. And it isn't there. Again, I always try to be respectful because it's a difficult and a competitive landscape. But I think if you had someone from there on, they would tell you the exact same thing.
Yeah, it's very interesting. And actually, you mentioned, I mean, the MIEX, Miami's competitive issue where they've come out of the options business is quite fascinating. And also they're running, 3 options businesses and and a good exchange with, I think, like 150, 160 person headcount, which is pretty impressive compared to a lot of the cash exchanges are running larger headcounts than that just to run cash businesses. It's fascinating. So you've got this amazing landscape in the USA. You've got all of these different ventures and then a multiplicity of different ATSs across the board, which are offering all manner of different models there, because you've obviously got the block facilities, like say, for example, BIDS and LiquidNet. Correct. And then how do you fit into that whole landscape?
Yeah, it's interesting because IEX became a stock exchange in 2016. So we started off as an ATS at dark pool. And to an extent, a lot of people have called us, a glorified dark pool, if you will, because until October of this year, roughly 90%, I think it's technically 88% of our volume was dark. So we had focused on a dark solution, and to be honest, I don't take that as disrespectfully whatsoever. I'm very proud of what we've done and how we've grown. I mean, we are the largest midpoint venue in the world now in terms of volume. Like others will say they do more block and all this type of stuff, but just straight up midpoint volume, IEX is number 1. So that's been exceptionally good. And I believe, we never had any of our owners seeding us with volume because our owners were the buy side. Now what we've done is we've launched a new solution where we use the same technology that we've always used to protect dark orders. We've done the exact same thing recently with lit orders, and we were approved with an order type called D-limit, discretionary limit it stands for. We launched that in October 1st, and we've since now gone to about 70% dark, 30% lit. So our goal, obviously, if you look at the U.S. equity market segment, those of you listening from the U.S. will probably know this, but just to give you an idea of the overall pie, about 12% of it is midpoint. About 52% of it is at the touch displayed, right? So IEX was competing until October for about 12% of the market. Overall, like today, I'm looking at on the screen, we're a little bit over 3% of the overall market. But of midpoint trading, we're about 14% of all midpoint volume. So like Patrick was saying, yes, you have 16 exchanges now, and you still have 30 plus dark pools. And most of the dark volume is done off exchange in those dark pools relative to the exchanges. So IEX, it's us and NASDAQ really do midpoint trading. The vast majority of the other exchanges are way lower than us.
It's quite fascinating altogether, really, looking at the sheer complexity for what is just a binary. I mean, buying a stock, selling a stock is quite mind-numbing to look at how complex it is. Ladies and gentlemen, I'm here with the president and a co-founder of IEX, one of the most exciting stock trading venues and exchange in the USA. They're famous, of course, for having appeared in Michael Lewis's book, The Flash Boys, but there's so much more. We're talking about technology, networking, routing, and the like, and the whole outlook of the exchange business. If you've got a question, drop it into the comments below. We'd love to answer it for you. And indeed, I do believe we have a question has just arrived. Someone on LinkedIn, they're an anonymous user.
Nice.
Good evening. Lovely to see you.
Yeah.
So, Ronan, let me ask you the question. What is the likely future for exchange data centers in New Jersey, given the possible transaction tax?
Yeah, that's the kind of topic du jour at the moment, right? So those of you who are not aware of this is the New Jersey government proposed a financial transaction tax, whereby they would tax every trade that's done in New Jersey, which means, like I said earlier in this podcast, every single U.S. equities trade is done in New Jersey. Most asset classes actually are in those same data centers as well, like options and futures, but just equities, to stick to our knitting here, is there's a proposed transaction tax, and the original proposal was kind of insane. It was a huge amount. So a coalition was formed with a bunch of sell side firms, some retail firms as well, and IEX is part of that coalition. And we've been having conversations with New Jersey government, right down to the assemblyman, as to what this means. It's not as easy as just assessing a tax on a per share basis, because if you think about it, and it's the same, I know, like in Europe, is the exchange's capture rate on a per share basis is very small. Like it's fractions of a penny, sub 1/10 of a penny. If you start putting a tax upon each and every trade, and you're doing that because the exchanges are in New Jersey, what happens is that tax invariably gets passed downhill, right? Tax goes back to the broker, broker's tax goes back to the institutional investor, goes back to the mom and pop on the street. Like the exchanges, it's not that we're just like collecting pots of gold every day, can't sustain a tax like that. So what we've tried to do is, in talking to the, and by the way, I don't want to appear anywhere near insensitive. It has been a very difficult year for a lot of states, and particularly New Jersey has had a lot of problems with COVID, and I can completely understand why they would try and seek some tax. So what I would say from the data center standpoint, yes, there's a lot of posturing where the New York Stock Exchange ran their Chicago Stock Exchange out of Chicago for a week. NASDAQ have run one of their exchanges out of Chicago, because the funny thing is, all of us, every single U.S. equities exchange, our disaster recovery is all in the same building in Chicago, 350 East Cermak. So it's kind of funny. Everybody's in 4 buildings in New Jersey and 1 building in Chicago. So in any case, there's been a lot of conversation around, listen, if you're going to come and just tax us for using your data centers, you also tax the Equinexes and the data centers that are in your state, but you want to tax us on a per trade basis. Why don't we look at other states? So what has happened, and I don't say it's a veiled threat, what has happened is a very real look and garnering pricing from different states. Where would we all move together? And you don't want to jump out of the frying pan into the fire and move to a state that's just going to tax you when you get there. So we're taking a very real look at what the options are. But then, truth be told, what I would say is, if people can come to the table in a more rational, vein, I think what can happen is we can stay in New Jersey, and there'll be some form of tax. This is just Ronan's opinion, not the coalition's opinion. But I think realistically, if cooler heads prevail, moving data centers is not just chucking your servers on a truck over the weekend and driving to another state. It's a massive lift, and it's very costly. So what you want to be careful you're not doing is biting off your nose to spite your face. So I think in any case, what's going on right now, I don't want to call it posturing. It's just a lot of discovery, a lot of conversations, and a lot of things you'll see in the press is where, the exchanges are going to move out of New Jersey. I still think that there's a high degree of probability that the exchanges will stay in the exact same data centers in New Jersey where they are. However, it's not completely implausible to think that we would move if such a tax was levied, because it just would not be sustainable. And there's a lot of difficulties. Like, again, the U.S. is a big country, but you have pensions from Texas and pensions from California sending their orders to New Jersey, and now they're going to have to pay New Jersey taxes, and they're not even part of New Jersey. So there's all kinds of angles to this. It's not just the exchanges and the brokers pushing back. The institutional buy side and the pension community will be pushing back on New Jersey as well. So it's remained to be seen.
Hashtag It's complicated. I think that
Yes.
can reduce that in 350 microseconds.
Yes.
Really interesting. Do you agree with what Ronan's saying, ladies and gentlemen? Drop us a comment, ask us a question. We've got Ronan Ryan here, the president and co-founder of the IEX exchange. Now, the Investors Exchange, IEX, it's interesting. We've talked a lot about this networking, the data center thing. Let me ask you just one supplementary in the data center issue. Is it not fair to say that the New Jersey data centers are getting, one, rather full, and B, are rather close to utilizing a huge amount of electricity? If I remember correctly, there are some peaky issues around about the New Jersey data center scene anyway. Not that it's going to disappear this year, but in 5 years' time or so.
Yeah, I mean, if you think about it, so you're exactly right. It's mainly 4 campuses, right? There's the New York Stock Exchange family. They own 5 exchanges. You have NASDAQ. They own 4. We're in a data center actually on our own. We're in a data center in Weehawken, and then everybody else is in the Secaucus campus. And sometimes people think it's one data center. It's actually a group of data centers on the same street, and they're all interconnected. So if you're in one data center, you have the same speed in between data centers. They're pretty full, but what I would say is what you've seen in the US is because exchanges, IEX is the only exchange that doesn't charge for market data or membership, have to get that little plug in there. But the exchanges are charging so much money for technology. Co-location is becoming expensive that for economies of scale, you'll see there's actually a decent amount, particularly on the prop side, the high frequency side, there's consolidation in that market. So what I would say to that is that there's going to be less and less members. Like, so members are the members of the exchanges are the brokers, whether it's an agency broker, a bulge bracket broker, or a prop trading HFT firm. They're all members. There's actually less members trading on the exchanges now. So what I would say is I don't think we'll run out of space. The difficulty, and I think what you're referring to, Patrick, is that as compute power gets stronger and stronger and stronger, you can fit more power in a smaller square footage. And what that requires then is more power distribution, power consumption from those computers. So now it's not really a matter of space. It's a matter of getting enough power to power that space, but also power to supply the cooling to cool that space. So a lot of times you'll see these big spaces in a data center that are all caged in and there's nothing there, but all the compute power is in one segment of that cage, because in order to get that much power and the ability to cool it, you have to buy more space. So it's kind of funny. You kind of view it as you think there's more and more people moving in. There's actually less people in the data center. It's just those that are there are taking far more watts per square foot than ever before. And that can become problematic. And at some point, push is going to come to shove and the data centers won't be able to supply that type of power. But back to the previous question, that's what makes it hard. Exchanges can't just move to another state. You need to find a state where the infrastructure exists, where all the connectivity is there, where you have this level of power per square foot in data centers. It's not as easy as it sounds. Not that I'm saying that New Jersey have the exchanges over the barrel, but it's not like you can just hop on a truck and move to Pennsylvania one state over. It doesn't work that way. So it's like you said, it's hashtag very complex.
Yeah, I mean, it is complicated all around, but at the same time, obviously, it's fascinating. I'm not going to ask you to comment on it because obviously all of these things are private, but certainly the newspaper reports today that are talking about the idea of you looking towards Texas, amongst other exchanges. I mean, that's fascinating because they do have the potential to deliver the space, but they're not going to do it by next Thursday.
Correct. Yeah. So and Texas does. It's kind of interesting. So I used to work in the networking and the data center space, and some of the biggest hubs in the U.S. are from that standpoint in terms of having the data center space, having the network interconnectivity. It's really Arlington, Virginia area, Texas, and Chicago. And a lot of people will say Chicago's in Illinois. A lot of people say the state of Illinois is in a worse state than New Jersey. So maybe if you move there, the taxes are going to rain down. And I think Texas has been very interested in moving Wall Street, I guess, a little bit west and south. But Texas, just from my technology days, does have the data centers. It's a massive place for things like the cloud. So like Google and Amazon and Azure all have big presences in these major carrier hotel areas around the country. So it's kind of funny to people outside of that technology space. They might not realize that Texas actually is a big player in that space. It's not just because geographically they have a lot of space. They already have a lot of this technology in place. And besides the fact that it's a pain in the ass for us all to move down to Texas, like I was saying, a data center move is not putting things on a truck anyway and moving them over the weekend. The only way we as exchanges, especially exchanges, because we're regulated so tightly, we're going to have to build our environments if this happens, 100% bring them up in another city and do a cutover. And like I said, that becomes very, very costly, very, very complex. So it would take, I think rational heads, cooler heads will prevail, and we'll end up staying in New Jersey. But again, that's more my viewpoint. But I hope I'm right.
It'll certainly be interesting to see what comes of the whole discussion. Certainly, you've got Governor Abbott of Texas, I see, salivating at the prospect of this business coming his way, which is It's good to see somebody who's eager to want to expand the capital markets. And hopefully, therefore, the New Jersey State Legislature will realize just what an exciting piece of business it could be losing.
Yeah.
It's interesting. We talked about technology. We're going to probably carry on to that. But we have another question from Martin Watkins, an esteemed member of the parish, previous guest on this IPO livestream. Good evening, Martin. It's lovely to see you. So, Ronan, what is your perspective on digital assets?
Yeah, it's from our view, and I'm sorry that this answer will be relatively short. I will say we're far from waving a victory flag in what it is that we're trying to do over here. And when we look at digital assets and crypto and all of this other stuff, I think what we've done is we've decided to stick to our knitting, and we've stayed away from that completely. I know other exchanges are kind of barking up that tree a little bit, but it's just in truth, anything I tell you right now would be just my own opinion and not worth opinion sharing. We're sticking to our knitting, and we really need to get IEX up and running and get some more relevance in U.S. equities.
Okay, but may I just ask you something? I just remembered. Didn't you have some sort of an involvement with a gold distributed ledger spin-off?
Yeah. So what we did is it's called Tradewind Markets, and this was back in 2016. We were filing to become a stock exchange. So what we decided to do is split that off. So there was a small group within IEX. Those employees left. It's a completely separate company. I guess you would call it a joint venture because we invested in it and we own a portion of it. And essentially what we did is we ceded them some technology. So the spirit behind what they do there is that actually physical gold is stored in a mint. The Canadian Mint stores physical gold, and you can trade on tokens that are directly attached to physical gold and take delivery of physical gold. So it was a tokenized way of trading, settling on the blockchain. And what I would say is I'm not saying it wasn't successful. It actually works a little bit. The problem in the US is most institutional investors, they're beholden to either their trading mandate or their mandate with their investors, as well as the 1940 Act. And this type of technology is not yet deemed a security. And that's something you would have to go through a whole SEC regulation in order for it to be deemed a security. And as such, many of these firms, while they think it's a much better way of buying and holding and selling gold as opposed to the GLD ETF, because it's not a security, it's made it very problematic. So yes, it's up and running. The company is in place. But in terms of volume, I think it was a little bit ahead of its time.
Interesting, yeah, because obviously those restrictions on holding gold in the United States of America remain somewhat tricky. And if nothing else, they fueled a generation of great Bond movies and other things that were all related to the issues of trying to attack Fort Knox, and rest in peace, Sean Connery. Just looking at that whole thing, I mean, we've sort of skirted around this. We've been talking about technological innovation. I'm very happy to talk about that more with you. But actually, this whole COVID thing, I mean, just talk us through it. What's it been like as president of IEX, trying to do both your functions and keeping the whole exchange running through what has been an amazing time?
Yeah, I will say this. So I guess it was Monday, March 16th is when it really, really hit the fan, if you will. And that week, as I talked to like brokers and other exchange executives, that was the most operationally tough week, right? So volatility went bananas, message rate went through the roof. Like we as IEX were doing over 1 billion shares a day. If you think about that, 1 billion shares on a normal day would equate to about 7 to 8% market share, when we're about 3% market share right now. So this is just to give you an idea of the volume. What I will say, and you said it earlier, Patrick, I've been very impressed with all the exchanges. No exchange had any technological issues whatsoever. Most every broker's dark pool handled well. Some of them had issues that first week and just failed over to other dark pools. But the entire interconnected system worked very well. Obviously, we had the market-wide circuit breakers that went off, I think it was 4 or 5 times. Again, they operated perfectly as designed. Some conversation came out of them as, should we change the design? Should we not have it in the first half hour of the day? Things like that. But all in all, they operated exactly as designed, no technological glitches. So that part was tough, I have to say, because that was the first week. And we're like, oh my God. Also, no one, I don't think, expected that we would still be out of the office 7 months later. So I'd say the early months were most difficult because we were just making sure we were learning how to use like video conferencing. It's funny, like I always joke, but if someone asked me to Zoom them about 2 weeks before COVID, I would tell them to go fuck off. I'm not getting on a webcam with you, right? And now it's like the new norm here. I'm on Zoom like all day long. So it's funny how things have progressed, but we've gotten very good at how do you onboard people remotely? Like I said earlier, we've taken on 35 people and we've onboarded 35 people successfully while we've been out of the office. If you asked me, could we do that a year ago? I would say no. Why would we do that? So I think it's like us, like everyone else, and I think like every industry, or like even my kids with school, everybody has evolved remarkably well. And now when I look at it 7 months later, a bunch of us chose to come back to the office because we liked the interaction of the office, not having to hop on a minimum 15-minute Zoom to ask a quick question. But I will tell you, we can absolutely run this venue, and I'm speaking for all my competitors, without being in the office. There really is no need to be in the office. I don't think you would want to do that permanently. I wouldn't choose to work in a job where I was 100% remote, but all the system worked. And I think we take a lot of pride in that. And I'm also very, very happy to see that our competitors didn't have any issues there. It would have been a disaster if some exchanges were experiencing troubles during that volatility. And then even days like yesterday, right? Obviously, you said something happened last week in the US. But yesterday, I mean, we did close to 1 billion shares again. It was especially in the morning, it was even higher volume, higher message rates than in March. And again, I heard nothing across the street of anybody having any issues, including the 3 new exchanges, which is great to see. So I think everybody has evolved, and it's funny. There's nowhere open for lunch right now here, so we're all bringing in our lunch and things like that. You kind of learn as you go. We have a Keurig machine on the desk because we don't have all the coffee machine in the kitchen, and we're not supposed to touch things in the kitchen. So humans are very adaptable, and I think everyone's done a very good job during this. We've been pretty blessed, actually.
Yeah, it's quite incredible, but at the same time, the ability to interact in 350 microseconds or less in the kitchen is obviously cutting back on what's going on. That's one of the reasons why I do believe, ladies and gentlemen, lots of people like reading Exchange Invest. So if you want to learn more about what's going on in the world of exchanges every day, and you want to join people like Ronan and last week's guest, Alistair Haynes, and indeed all of the guests who've been on this show, then please send us an email, send us a message via any which way you're watching this particular event at the moment or listening to the podcast. We'll be delighted to hear from you and give you the opportunity to subscribe to the Daily Bulletin of the World of Exchanges. It's fascinating what you're talking about, the whole way that this industry has really done incredibly well. And I thoroughly agree with you. We have to applaud everybody. I mean, certainly yesterday it was funny in London when you were having that explosive morning in New York, all the exchanges functioned fabulously well, but it was actually the brokers ended up running out of bandwidth and headroom and having problems. And that's obviously not good for anybody. It was a real shame. But it's incredible how really, really well we have functioned during this. And we do need to applaud everybody because let's face it, slightest problem, everybody goes absolutely batshit crazy and screaming and yelling and abusing everybody. And it's just amazing what has happened with the cornucopia of interrelated marketplaces. Even if they are all executing within 3 or 4 city blocks in New Jersey and other places in the world, So tell me a bit. I mean, looking at the technology and the development of markets, we're just into the last 15 minutes of the whole discussion today. What do you think are the things that are on the agenda, Ronan, going forward? Not asking you for state secrets, but what's happening in the general all-round development of how markets are likely to change in the near future?
Yeah, I mean, it's an interesting time, right? So again, when you have a new president, whether the president was Trump again or whether obviously it's Biden now, the SEC have turnover. So the SEC that we interact with, the division is trading and markets, but there's also the commissioners, and Jay Clayton will be leaving the SEC. So who's the new commissioner that comes in? And why I say that is the last 4 years have been pretty interesting in that I don't think we've ever had a regime within the SEC so fixated in a positive way on market structure reform, right?
Yeah.
So it's like a lot of times I think the regulators are sort of made fun of, they're chasing baddies and Porsches and they're on bicycles and all these other things that they say about them. But I will say the SEC over the past 8 years, I'd say that regime has become more and more progressive. And I think having someone like Brett Redfern as head of trading and markets, someone who actually worked on a trading desk, that was a smart move. I don't know who the next head of trading and markets will be or who will be the commissioner of the SEC. But I think, if you've watched the US, the SEC tried to put a pilot into place to test the rebate models, right? So it's been a I'd call it an angry not as angry as last week, but an angry back and forth in the industry on whether rebates are good, bad. And what you've seen is in the past year or two, the SEC proposed a pilot to test this out. And as many as you might know, but the New York Stock Exchange, NASDAQ, and the CBOE, they actually sued the SEC to stop the pilot, and they were successful in doing so. So from a market structure reform, I don't know if the new regime take another go at this, Patrick, but that's more macro to market structure. From a micro standpoint, what we're looking to do is we recognize that the brokers, our members, are the delivery vehicle of every product that we come out with. So we're partnered with the buy side, we're partnered with the brokers, and what we want to do is see what can an exchange do, because there's a lot of things, if you think about it, in the US in particular, but I'm assuming it's the same globally, where exchanges and brokers can kind of get pitted against one another, saying, well, what you're trying to propose as an exchange, that's really the function of a broker dealer. So are you competing with me? And that's been sort of the view in the past. I know some exchanges tried to do a VWAP algo in the past, and then that got stopped because that's the function of a broker dealer. Anyway, long-winded answer to your question. What I think you will see through technology and where things have gone is some of that functionality will leave the brokers and be managed by the exchanges only. I say this because the exchange is at the center of the ecosystem. For example, because of our speed bump, because we give ourselves a 350 microsecond head start, because we're right in the middle of this, we can see things that no broker can possibly see, and we can do things on their behalf that no broker could possibly do because of that advantage, if you will. And the advantage is not for IEX. The advantage is for those people trading on IEX. And I think you'll see things like you saw CBOE. They did like an MDO order type. NASDAQ have even done a side book called Mellow. And I think exchanges are starting to do things that are solutions for the broker dealers, because the broker dealers, no knock on them whatsoever, just because of their position in the ecosystem, can't handle some of this stuff. So let the compute power be handled at the center, at the exchange. It's sort of like, it's the reverse of edge computing, I guess. It's like central computing. But I think that's what you're going to see going forward. And, if the past year, like the IEX approval of D-Limit, NASDAQ success in Mellow, the MDO order type, is that what it's called? MDO depletion order, that CBOE did, all of those things lead us to believe that that's kind of like the track forward. And the fact that the regulators are comfortable and we're comfortable in approving all of those things, I think sort of leads the way for that level of innovation. So when people say, oh, can things get any faster? Things can always get faster. Latency can always be eked out. But I think now the exchanges, and it's like I said at the beginning of this interview, we started an exchange because we realized to address some of these issues, you needed to be at the center of the ecosystem. And I think that's where technology is going.
And that's fascinating. So you need to be at the center of the ecosystem. You need to be essentially a proper exchange, as it were,
Yep.
rather than just an ATS, to really own part of that stack of everything that's going on and understand what's happening. That's a really, really interesting observation, actually, Ronan, because it's quite different to how many people might see things. And particularly, you look at like the crypto kiddies who are all off talking about decentralization,
Yep.
which I actually fundamentally don't see how you square that with even the current SEC, who've been very deregulatory and much more mellow. If you get a huge move towards being more hands-on, it's very difficult to see what happens with the SEC there.
Absolutely.
Great to hear what you're saying in positive terms about the recent SEC. I agree. I mean, I think Chairman Clayton and his team have tried really hard to do a great deal of things for markets. They may not have always been things we agree with, but at least they have been trying to do stuff that is coherently trying to make a better market for investors.
Yeah, I agree. I look, like you said, if you don't agree or you agree, what they did do a good job of, and I think their predecessors could have done a better job of, is actually communicating what it is they're doing, what their view is on it, why they're doing it, and at least it doesn't leave you in a "what the hell are they doing" type frame of mind. And I think that's been great. So communication and interaction with the street overall, not just IEX, by the way. I mean, they take meetings with everybody. I think has just increased over time. And compared to the SEC, and again, I always tend to not knock the regulators, not just because they regulate us, because it's a harder job to do than people think. But what I would say is, over the past, call it 8 to 10 years, they're getting progressively better and better and better. And we've been very impressed with them. And I say that not as a regulated entity. That's a hand-on-heart opinion.
No, but it's very interesting because also you look at the complexity of what they're trying to deal with is unbelievable because 10 or 12 years ago, I mean, they didn't have upstarts like you, let alone Members Exchange, Long-Term Stock Exchange, Miami's, Pearl, et cetera, and a dozen different or more ATSs. So, I mean, it's been getting a more complicated environment all the time, and yet they've been trying to do a better job. It's very, very heartening to hear. And certainly for those of us who sit in Europe and actually are frankly confused by what on earth American equities execution actually means, because you roll off all of these sorts of different brand names and you talk about your D-tips and your something or other else, and there's certain order types that sound to me like, I thought the last time we were talking about those was when they were taking the waste out of Chernobyl's nuclear plant and things like that. It's confusing. However, actually, I've got a great question for you, and it's a pretty simple one that's come in from another of our LinkedIn users. Good evening to you, wherever you are in the world. Can you continue to give away your data for free?
Yeah, that's a great question, whoever asked that, I have to say. So what's very different to IEX is this. We don't charge for anything other than the trades. But what we do, and we've been able to continue to do, is we charge both sides of the trade. So if you trade displayed on IEX, it's 3 mils a side. If you trade non-displayed, it's 9 mils a side. So, capture rate is what other exchanges look at. They'll say, I charge a take fee of 30 mils, I rebate it 25, my capture is 5 mils. So if you look at it that way, our capture is 3 and 3 is 6 mils for displayed and 18 mils for non-displayed. And 18 mils is a rich capture rate. However, if you think about it, these exchanges that pay rebates, who's getting the rebate and who's paying the 30 mil take fee? So not only are we cheap to interact with, but we have a nice capture rate. And back to what you were saying earlier about like MyEx, Patrick, there's only like 92 headcount here ascribed directly to the exchange. So we can do this in a lean way. What I will say is, and many on the street have asked us, so your question is, can you afford to give away your data for free? The question we get asked is, should you be giving your data away for free? Because many brokers, members who would actually have to pay us for the brokers, are suggesting that maybe we should charge for the market data, because by giving it away for free, are you devaluing it? Could you instead charge for the market data, but charge a more rational cost? So what we did in January of 2019 is we put out a white paper disclosing our costs. What does it cost us to provide market data? What does it cost us to provide ports? All of these things. And we said, what about charging for these in a cost plus model? And the reason why I say that, we haven't done it yet, but at some point we might start charging in a cost plus model. and say, hey, if it takes us $2,000 a month, costs us $2,000 a month per member to provide market data, how about we mark it up X%? The big frustration in the US is that, like I said, there's less and less subscribers. There's less brokers than there were last year, than there were the year before. And if you listen in on the three families of exchanges, NYSE, NASDAQ, and New York Stock Exchange, they constantly talk about on their quarterly earning calls how subscription revenue is going up. So how is subscription revenue going up, but you have less and less subscribers? The only way that can mathematically happen is that you're charging more and more to each subscriber. And we get a lot of people complaining about the model of the exchanges because we're an SRO, self-regulatory organization. We can basically over here charge what we want because you have to connect to us. That's the way the market structure is set up. So it would be novel for an exchange to charge for market data so it doesn't devalue it because they just give it away for free, and charge for it in a markup fashion. But anyway, long story answer to your question is we can continue to afford to do it for free because the economies of scale. We have 90 plus people here. We did 7% of the market, if you want, in March without adding another body. We don't need to add bodies as we grow to do more volume. So I'm not doing an even villain voice, but we have a fairly rich capture rate, and we might charge for market data down the line. But I can tell you 100% it's not something that we need to do. It's not something that we had planned to do. And more, we've been implored to do it by our members, which sounds funny, but if you think about it logically, why are people sort of asking us to charge them money? Because they want someone to lead by an example and show that you can provide market data and provide it at a reasonable price. So that's why I say maybe we will do that at some point.
And you know what? On that note, Ronan, I think it's absolutely fascinating to end today's discussion. You have been a fabulous guest. One of the things which delights me is we may have been separated by COVID. We may have endured social distancing, but at the same time, IEX has remained open with its lovely 350 microsecond speed bump. And more significantly, look at what we've done today. It's fantastic. We've managed to bring together some bloke from Dublin with some bloke from Belfast, across the Atlantic, sitting in Malta and New York City, respectively. We've had an amazingly low latency discussion. We've talked about markets. We've talked about all sorts of aspects of the business. I wish IEX every success, and really it's been a pleasure chatting with you today. Ronan Ryan, our guest, president and a co-founder of IEX.
Cheers. Thanks very much.
You're very welcome, Ronan. Thank you very much. And so, ladies and gentlemen, as we bring this show to a conclusion for this week's exciting episode with our great guest, Ronan Ryan, fascinating to hear what he's been talking about, the idea that he's running a complete US exchange with his co-founders, with Brad Katsuyama and so on a staff headcount of only 92 people. Quite spectacular, as he was saying, basically doing like 7% of the business in March. And we're talking about some days being $1 billion in matched equity, which is a spectacular number for any exchange in the world to manage to do at any point in time. And certainly we've touched upon the business of regulators. Very interesting to see what's going to be happening, as Ronan has mentioned, particularly as we've come out of what really has been somewhat of a golden age for the SEC, the Jay Clayton chairmanship being something that has allowed markets an opportunity to breathe. Not all market structures agreed with all the things they've been trying to do, but it's certainly been a stint of progress. And I suppose some people are going to be rather concerned about news coming in from the apparent incoming presidency of Joe Biden that he may be tapping Gary Gensler, the former chairman of the CFTC, to some form of Wall Street oversight review, or indeed trying to help by choosing the team for the future regulators, because that may, of course, presage somewhat more of a tricky time for the regulation of financial markets, as we saw during Mr. Gensler's period as chairman of the CFTC previously under President Obama. Of course, at the same time, it's interesting to look at the long-term history of markets, ladies and gentlemen, and think about what's been going on in the last couple of days. We've seen spectacular numbers coming out of Japan. The Nikkei Dow index, it's actually managed to reach, good grief, 24,000 and something points, a level that hasn't been seen since late 1991. Quite spectacular, but at the same time, a salutary lesson in bear markets. Remember, the market Even though it's been close to 25,000 points this week, it peaked at 38,915 points on December the 29th, 1989. For millennials amongst you, that seems like ancient history. This show, on the other hand, is not going to be waiting around to be ancient history, but you'll be able to access it on Facebook, LinkedIn, and YouTube as usual. We're going to be back next week. We've got a very exciting team going to be talking to us from NASDAQ. We're looking at the VolQ index. Is it the future of the volatility industry overall? And how does it compare to the VIX? That's our topic for next week's live stream. This week has been a spectacular show once more. Thank you, Ronan Ryan, president of the IEX and a co-founder of that epic Flash Boys exchange. My name is Patrick L. Young. I wish you a great week in markets.